Hello and welcome back to another episode of the weekly news on the For the Property Investor podcast. And of course, we have the only co-host for this segment that I could have, the man who brings the news, Nick Bendel. Welcome,
Oh,
Nick.
thank you so much, Owen. It's great to be here, and your introductions are so flattering.
Oh, thank you, Nick. I practice in the mirror every morning. Just so I can get it right, get it perfect for your introductions. But how has your week been in this still early new year? What's been happening?
Well, it is 2025, still getting used to saying that. But it's strangely, this might sound strange, but it does feel good to be back at work now, to get back into the swing of things and trying, like so many of our listeners, to build my business. In my case, my business is Hunter and Scribe, a copywriting agency. We write content for finance and property professionals. And over the past week, I was contacted by two businesses, one a credit repair agency, another a building company, asking if I could help them with award submissions. Award submissions is something that my company, we're really, really good at. I think from memory, we helped 7 or 8 businesses qualify as finalists in awards last year, and I think 2 or 3 of our clients actually won awards. So it's something that we're good at, something we enjoy doing, and so when someone contacts me to ask for help with an award submission, it's something I always like helping with.
Very good, and I would highly recommend your services to anyone that needs that help. Very good. Getting busy nice and early in the new year. Good to hear, Nick.
Well, thank you. I appreciate that. How was your week and the week for Leifield?
Well, yeah, you talked about getting back to work. We never really stopped. It's didn't really have a break except for those ones that we had to on those public holidays. But yes, it's continued on with the record month of leasing. Of course, we're a national provider of property management services, so we've had a lot of leasing in January. I think it'll be our biggest month ever for which is quite strange for a January. It's normally fairly quiet, but um, yes, it's not complaining about it. It's a good problem to have, but it would have been nice to have a couple of days off. But so we're still dealing with that. Things are starting to calm down a bit more now, and yes, we're looking forward to getting into the new year properly. So onwards and upwards.
Well, that's actually a very nice segue into our first story. Shall we start with that?
Yeah, let's get into it. What's in the news, Nick?
Our first story, Owen, is rental slowdown continues. Australia's median rent increased 6.9% during 2024, according to PropTrack, which seems reasonably high. However, the rate of growth did slow throughout 2024, and in the December quarter, rents rose only 1.6%, which was the slowest rate of growth since 2021. PropTrack says there are two main reasons for this slowdown. First, rental supply has increased, which has put downward pressure on demand. Second, rents have risen faster than wages over the past few years, which has made it harder for tenants to keep paying higher prices, which of course is dampening demand. Owen, Leifield is active in 5 different states. I'm wondering if we could go through them one by one. Could you let us know
Sure.
what you're seeing on the ground, firstly in Sydney?
In Sydney, the rental market is still fairly strong. The pace of rental price growth has slowed considerably in the last 12 months, but it is still growing, but at a much more reasonable, normal pace. So there was there will be exceptions to that in on both sides of the coin. So there'll be areas that will be rising quickly, but then there'll be others where we've even had to drop prices because there might be a oversupply in that area for that type of property that might be on the market at that point in time. So yes, but fairly healthy market. prices aren't going nuts. So yes, it's a fairly good market in Sydney.
Okay, what about Melbourne?
Melbourne is it's very dependent on the area. There's a lot of oversupply in some areas and like huge amounts of oversupply in some areas, especially in the Western Corridor where there's a lot of new builds. That being said, it's the supply is very much needed. But if you've got a property in that area and you're trying to get it leased right now, could be very difficult, and you're going to see that you're needing to drop prices. In other parts of Melbourne, fairly similar to Sydney, where it's fairly healthy, might not be seeing much growth at all, but fairly healthy in terms of supply and demand.
And Vegas?
Brisbane, pretty healthy as well. Again, the price growth has slowed down a lot as the numbers have shown overall, but there's still a lot of demand in some areas. There's oversupply in others. So it's can be a bit hit and miss. It just depends on where you need to live and what's available at that time. I always recommend if you're struggling to find a property in your price point, look a bit further afield. It's don't be scared to get out there and discover new areas to be able to get the property that you need at your price point. Because they are available in every capital city. It is possible to get the property that you need at your price point, but it might not just be in the area that you're used to living in.
And what about Perth?
Perth. Perth has had an interesting ride in the last 12 months. It's been with prices going up, and then it's slowed down with a lot of stock coming on the market. So we started seeing areas where there was a lot of supply in the market, so prices had to be adjusted down. And now it seems to be swinging back, where we're now starting to see a bit more competition for properties, and prices and properties getting leased fairly quickly. The only exception is in some of the new build areas where before Christmas we did see a couple of areas that did have a lot of properties on the market, and we had to meet that market by bringing prices down. So and I think that's what's reflected in the overall figures, where they're saying the rate of growth has slowed through the last 12 months, where some areas are offsetting others, and where it's not across the board booming market. So we're seeing that in most markets.
And finally, what about Adelaide?
Yeah, Adelaide, pretty much the same. It's in some of the newer build areas where there's a lot of stock coming on at the same time. Same issue. Prices might need to be adjusted in the short term until that new supply gets dried up, and but in the rest of the city, still fairly healthy. Properties are getting snapped up fairly quickly, but it just depends. And these markets can change from week to week. So you might have one suburb this week where there's a lot on the market, and then those properties get snapped up. But then in 2 to 3 weeks' time, once that supply has dried up, you then might find that there's slim pickings, and you might have to look further afield then.
Well, as you noted, Owen, real estate is very much a market by market proposition. That said,
Yeah.
throughout 2024, at a national level, there was a clear slowdown in price growth. Do you
Definitely.
think that's going to continue in 2025?
I think it will. That like we've still got the bigger macro issue of not enough supply in the marketplace. We've still got the issue of inflation affecting the building costs. So for developers and builders to be able to get in and build more properties, it's becoming more expensive. And because the prices have slowed down as well, price growth, values of properties have slowed down. That makes it um, difficult for builders to be able to take that risk to go out there and build these properties with rising costs without the underlying value of these properties increasing at the same rate. So yes, it's going to be a difficult market this year, but there'll be winners and losers, and that's where people need to get themselves educated, do the research, work out where they can get value for themselves when there is more supply in different markets where they might not be considering to necessarily live themselves, but in the past. So yes, it'll be another interesting year.
Thank you, Owen. Given that your property management business, Leifield, is in 5 states, I can't think of anyone more qualified to talk about different markets around Australia. I always value your insights. Thank you for that. Let's move
Thank you,
on
Nicholas.
to our second story. Labour market remains surprisingly strong. The unemployment rate rose from 3.9% in November to 4% in December, according to the Australian Bureau of Statistics. The unemployment rate in December 2023 was also 4%, and the unemployment rate has actually experienced very little change over the past year. However, the underemployment rate has clearly trended down during that time, falling from 6.6% in December 2023 to 6% in December 2024. Also, the participation rate, which records the share of the working age population who either have a job or are trying to find one, has risen during that time from 66.6% to a record 67.1%. So, despite the weak economy, more people are working and fewer people are underemployed.
Hmm.
Oh, and GDP per capita has declined for 6 consecutive quarters. Yet, if anything, the job market has actually strengthened during that time. Do you have any idea how that could have happened?
Um, yes, it's we're in a um, unique economy at the moment where um, the underlying economy is fairly healthy. What would boost that participation rate is the fact that our high immigration um, has um, has produced a lot more people who need to work. So the people who are coming into the country are probably people who need to participate in the workforce. So that would lift that percentage. Um, and the underemployment rate would be probably likely to the fact that people are hurting from a cost of living crisis, so they're getting out there and working in any way that they can. And and it shows that we're all going out there, we're hurting, we need to earn more income, and it's so people are trying to earn a dollar where they can. But it shows that there are jobs out there, and there aren't employers who are necessarily um, laying off lots of people all at the same time. There's definitely industries that are hurting as a result of cost of living crisis and inflation and interest rates. But people are cutting back in other ways. There is demand out there for business, so people need good people. Businesses need good people to be able to service that. So yes, it's and I guess that's the difficult job that the RBA has right now in terms of trying to manage where employment is, where inflation is, and what to do with interest rates.
Well, speaking of that, interestingly, the market still believes the RBA is more likely to cut rates in February than leave rates on hold. But do you think the RBA can afford to cut rates while the job market is still quite strong and wages growth is still quite high and inflation is stubbornly persistent?
Yeah, I'd be surprised if they do cut rates. It's there's no real new news either one way or the other here that would really give them confidence that they can cut rates. It's so I think it will be steady as it goes, and
The un-
they'll sit on their hands and wait.
as we've been discussing, the unemployment rate has been low for the past year. In fact, it's been low for about 2.5 years now. During your
Mm.
25 years of industry experience, Owen, have you noticed any link between the unemployment rate and property market activity?
Not necessarily directly. It's that's usually more directly affected by interest rates and inflation and GDP. And but then those factors have a direct effect on property prices. Um, and but they it can be more of an indirect effect. So yeah, sometimes in a high inflationary period, you can have property prices going through the roof, as we've experienced in the last few years. But that it's not necessarily correlated directly to that fact. So it's an interesting market still, interesting economy.
Well, let's move on to our final story for today.
Mm.
Wealth transfer reaches key milestone. Gen X, who are aged between 45 and 60, have overtaken baby boomers, who are aged between 61 and 79, for property wealth, according to KPMG. The average Gen X person has $1.31 million of property, while the average baby boomer has $1.30 million of property. Baby boomers have historically been the largest holder of housing assets, but as this cohort ages into retirement, they are beginning to sell down their property portfolios, said KPMG. However, the average baby boomer still has more cash than the average Gen Xer, 242,000 compared to 176,000. Baby boomers are gravitating towards liquidity and higher cash holdings, which reflect their inclination towards safer investments, said KPMG. Oh, and I don't know if you've been following this, but there's been quite a bit of talk about this massive wealth transfer. Over the next 20 to 30 years, we're going to experience the greatest wealth transfer in history as baby boomers pass on their assets to their children and grandchildren. One effect of this is that younger generations are going to inherit a lot of homes, some of which are going to be considered unsuitable, either because they're too old, or they're too big, or they're too small, or or they're in the wrong location. What consequences will that have for the property market, do you think?
Um, it will be well, we're talking on a very sort of long term. When we're talking about decades and on a very macro level. Um, it would depend, and most of that wealth would be in owner occupied houses as well. So you're not necessarily going to see a mass exodus all at once, but yes, over a 20 to 30 year period, it's definitely going to happen as either retirees need to downsize, um, or eventually they get passed down through wills and estates. And it's you're going to see that sell off on properties. You're going to see a lot of properties that where yes, they've been lived in for decades, and as empty nesters. And so there's going to be a lot of work that's going to be needed on those properties in terms of maintenance, and that's one issue with the pension system and the welfare system that doesn't make it easy for them to downsize. So it's I think there's going to be enough growth and demand as we can see now. There's not enough supply for properties, so the more supply over the next, especially in the next 5 to 10 years, that we can have in the market, I think it would be better. Or we might see more of families that are shacking up together in terms of multi-generationals. Um, and so that you've got the grandparents there to look after the grandkids. So that might be an option to be able to help those younger generations get into the property market sooner, or having that transition of wealth, transition of property ownership to the younger generations. Because remember, we're talking about only 1 or 2 kids in a lot of these cases. It's not like there's, a lot of families that had lots of kids where they need to necessarily sell these assets to be able to pass them down. So yeah, there's always those options. So again, it's going to be varied. It's not going to be this huge flood, but yes, it will definitely be the largest transfer of wealth, but it'll be done over a couple of decades at least. So I think it'll be a positive thing, providing more supply into the market.
Well, we've been talking about this great transfer of property. There's also going to be a great transfer of cash from baby boomers to younger Australians. Partly, it will be just direct transfer of cash, but then there'll also be assets being inherited, and the assets will be sold, and then cash will be the result of that. So I think we're going to see over the next 20 to 30 years a lot of younger people with big stockpiles of cash. Is that going to have any impact on the property market?
Well, yes, that'll help. The lot of Gen X and younger generations, crying out that they can't get into property ownership, and this is what will allow them and help them to do so. And but there's a lot of baby boomers that I'm sure are planning on spending the cash, or they might feel like they need to be able to maintain a standard of living. So who knows? They might say, "Don't worry about kids. Don't worry about you kids. Go and make your own money. We're going to go spend ours." So
Well, let's revisit this in 2055 and see how things look then. But until then, Owen, it's been another great chat and really appreciate your insights.
thank you, Nick. This was, yes, a very insightful conversation about what's in the news at the moment, and looking forward to the coming year. There's lots to happen, and it'll be a very interesting year, as we've already discussed.
Have a great week.
You too, Nick. Thanks.